Hey guys, this is Remy again on this video. And on this video, I'll be showing you how you can use the 7702 strategy in order to design a mortgage protection plan. Now, first thing I want to say is, what is a mortgage protection plan? A mortgage protection plan is a plan that will pay your mortgage, maybe your mortgage installments, if you get into any of the following situations. You're chronically ill, you have a critical illness, maybe you're disabled. At some times, at some level, depending on what mortgage plan you're using, it can pay when you lose your job. And of course, if you pass away, it's going to pay off your mortgage. Now, I want you to understand that this is very important because most of you guys or some of us who have mortgages don't understand how important this is. Now, we are able to pay for our mortgages because we are working, we have a job. Now, should you lose that job or should you get disabled and maybe you lose your job because of disability, your disability income might not be enough to handle your bills, to handle your medical bills, to handle your job, rather to handle your family and even pay your mortgage. So most times it causes a lot of families to stress. And when that stress gets in, that is when you see where families starts falling apart, right? A lot of veterans, nothing bad with veterans, guys. I'm just giving based on the examples of saying, but even some guys, medical doctors, even IT professionals, a lot of people are homeless because of chronic and critical illness. Now, what happens is that they lose their job, they cannot afford the mortgage, the house is placed on foreclosure just because they did not plan to put in a mortgage protection plan. Now, with a mortgage protection plan, guys, it's very important because if you lose your job because you're chronically ill, you might lose your house. Yeah, you might lose your house. If you're critically ill, you might lose your house. Now, think about it for a little bit. What about those kids? Now, think about your children. Think about your family. Do you really want to put them in that situation? What if you pass away? Now, I know the bank would sympathize with you. But guys, the banks are out for business. They need their money. They're going to kick your family out. So if you want to learn how to set up a mortgage protection plan that would help pay your mortgage, should any of these 5 happen to you, then stay with me and let me show you how this works. But first of all, I want to ask a question. When we talk about critical and chronic illness, now on my left side there, I'm showing you some critical illnesses, and on the right, there are some chronic illnesses. Now, if you cannot do 6 of the daily activities of daily living, if you cannot do 2 out of the 6, rather, it means you have a critical illness. Now, I want you to understand that this has to be certified by a doctor, though. So if you look at those, if you can do that, that means any 2 of those 6. Now, what about chronic illnesses, where you have a heart attack, stroke, cancer, or an end-stage renal failure like dialysis, right? Or you are living in assisted living, some kind of assisted living area. You have a major organ transplant, blindness, paralysis, central nervous disease like Parkinson, Alzheimer's diseases, coronary angioplasty, whatever disease, these critical chronic diseases, those are some of the things that really cause a lot of homelessness and a lot of poverty, especially in the United States. Now, what are your income replacement options? Now, these are some of the things you want to consider and ask yourself, God forbid, if this happens to me, What happens to my kids? Where are they going to stay? Who's going to pay this mortgage? Now, you may think your wife is working, but let me tell you the truth. If it is difficult for you and your wife right now, how will it look like if it's just high loan, right? Okay, so let me show you guys how this one. I just wanted to chip this in before I go ahead and show you how how this actually works. Okay, so let me bring in the other slide and we'll talk from there. So this is a mortgage protection plan for one of my clients, and she's a female from the state of Texas, and she is 39 years old. Now she has a mortgage. I think her mortgage was 280, if I'm not mistaken. But she wanted to do a little bit over that for her own reasons. And one of the reasons she did that was because she wanted to use this both for mortgage protection and at the same time use it for retirement income. So she decided to do a little bit higher. Now she's paying $570 every month for this plan. Now take note, with this her plan, she could do 270 and that would still be fine. She will not have any problem. It will work very well. Now, instead of doing the 270, she decided to add 300 every month into what she's doing because she wants to max it and also use it for a retirement income. So take note of that. I'm not saying that you have to do the same amount, but with 270 every month, this will just be fine. Okay, so let's look at it. Now you now see that on the first year of paying her premiums, she is able to pull out $2,000 right here. And she has a savings of $5,000. Now let's go down the road. If something happens to my client, let me say 5 years down the road, right? 5 years down the road, she has 31,000 in savings. And then she can pull out 29,000. Let's say she's disabled. Guess what? 331,000 is available, and she has a death benefit of a face amount of 300,000, which can be advanced up to 90%. And if that is advanced to her, she can use it to take care of her medical bills. She can use it to take care of her mortgage. She can use it to pay her bills. So because of that, that peace of mind is right there and my client is secure. Now, let's say she passes away. What happens? $331,000 will be mailed as a check or maybe direct deposit to the beneficiary. Possibly that could be the spouse or maybe the kids. That will help take care of the mortgage. I want you to understand that 5 years down the road, the $80,000 rather, that was her mortgage, would have been reduced. So they will have money to take care of the reduced mortgage and still have some to take care of funeral arrangement and still have some to take care of the kids. Those are some of the things you want to understand. And let's say nothing happens to my client and it was a 30-year mortgage. So I actually ran this policy for 26 years. Now, because I believe by 26 years, I don't think she should continue paying premiums, because by 26 years, the policy must have, the mortgage must have really gone drastically down, right? So there's no need running this for 30 years. Again, remember, you can always stop paying at any time, but this policy, it will run by itself even if you stop paying. So now, let's say nothing happens to my client, and let's say he's not sick, but maybe, just maybe, 10 years down the road, she loses her job. She loses her job, right? Now, when you lose your job, now some of these policies will not give you any money. Now, if it is designed with our 7702 strategy, you are able to pull $76,000 rather. So you can use this money in your surrender value and pay off your mortgage while you are still looking for a job. You can borrow this money and pay your bills and pay your mortgage and even feed your home. Take note, while you're still looking for another job, right? And I don't think it's going to take you 10 years, 5 years to get another job, right? Most times you easily get a job quicker and you're able to get back on your feet, but this will help you for job loss, okay? You want to take note about that. Now, let's say nothing happens, he didn't lose his job, he didn't fall sick. Now, this is what my client was thinking when he wanted to design this. I mean, most of the time I ask a lot of questions to actually know what are your main goals. Now, based on my client's goals, he said, if nothing happens to me, there are two options. Either you have your premium given back to you, they call that return of premium, or you want to advance that money for retirement income, right? So that actually can be designed with different types of policies. Now, with this one, my client wanted to withdraw money for retirement. And based on that, she could start taking at age 66. After she stopped her payments, she's able to start taking $48,000 every year. And remember, this money is tax-free because she's just borrowing from what she already has. So I want you to take notes. Now let's go down. Now you now see she starts taking this money at age 66. She's done with her mortgage. She's paid off her mortgage. Nothing happened to her. The money was not advanced. She didn't lose her premiums. So she was able to pull out money from the policy. So she has a retirement plan combined with a mortgage protection. Now, if you look at that, she pulls out this money right up to age 96 right here. Now, you mustn't pull it to 96 if you want to, that's fine. But look at something. She put in a total of 177. She was able to pull out 1.488 million. This is real, guys. Hey, it's not a game. It's real. Okay, now, but let's look at something. Even at age 96, right there, she has a cash surrender which she can pull out of 254. If she doesn't pull it out as she passes away, it gets sent to her beneficiaries. Now, I want you to understand that she's already done with her mortgage. This is just an add-on. Now, guys, you mustn't design it this way, okay? You must not do it this way. But guess what? This is awesome. Now, there are many, many ways we can do that with different policies. But guys, if you feel this is very interesting and this adds value to you, you want to learn how to do it yourself, or you want us to do it for you, whatever way you want it, guys, please, there's a button at the bottom. Click on the button, book an appointment, take the next step. And when you do that, one of our professionals is going to get to you and we'll try to see what works best for you.